Fed, I knew it was a bond bubble, and I was the first, I don't say the first, one of the first to recognize that we were in a global bond bubble. But I never imagined that 25% of the entire stock of global sovereign debt would have a negative yield. I would never believe, even then, that a sovereign nation could get paid to issue debt.
Welcome to the Power Market Report. I'm Albert Liu. I'm pleased to be joined once again on the phone by Michael Pento. He's the president and founder of Pento Portfolio Strategies, and he's also the author of The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael, welcome to the program. It's been a while since we've spoken. How are you?
I'm doing fine, Albert, and thank you for having me back, and congratulations on your success.
Thank you very much, Michael. We spoke almost a year ago to the day, and I remember our conversation last year. Overall you were bearish, but at the time you told me you were renting a position in U.S. stocks. Can you bring us up to date on sort of how your thinking has evolved over the last year? First of all, did your lease end before January?
So I was short stocks, and I increased my gold position in late December. I got lucky with that. And the portfolio, which is audited and tracked by a third party called HedgeCovest, I think we're up about 12% so far this year. So we're having a really good year here at Pento Portfolio Strategies. And the reason why I went short is because the Fed raised interest rates for the first time in practically a decade. And I just thought that if the Fed was going to raise interest rates into what I thought was going to be a recession, then it would bode very poorly for stocks. And it did. We had the worst start in history for any January for the S&P 500. But lo and behold, sometime around mid-January, we had a plethora of people who serve on the Federal Open Mouth Committee, FOMC, started to recant and rescind their hawkish stance on monetary policy, and that caused a huge reversal in stocks. And so I did go back into my rented positions of I owned Russia, I owned India, and I still hold my gold position. And I'll tell you what I'm worried about. I'm a very nervous bull in the stock market. And I say bull, it's very, very myopically focused in just those two countries, because you have growth and you have value in India. You have growth in India, you have value in Russia, but you don't have any of that in the United States. You have the worst of all worlds. You have really no growth. We're growing around 1% year over year, 1.2% year over year in real GDP. And yet we have core inflation up 2.3% year over year. So we're in a stagflationary environment in the United States, and yet we have stocks at the absolute thinnest of air. If you look at median PE ratios, if you look at price to sales ratios, if you look at total market cap to GDP, if you look at the CAPE ratio, the cyclically adjusted PE ratio, all these metrics show that we are way, way overbought, and only justifiable at these levels if you have a huge increase in earnings, or if the central bank stays on hold, if the Fed does not move interest rates higher. So you're not getting that bounce in earnings. Clearly, we actually have 6 quarters now of negative earnings on the S&P 500. So the only thing holding this whole thing together is the global QE and the fact that the Fed has not raised interest rates since December. So maybe we'll get another raise in December of this year. And I think we will, by the way, get an increase, a second increase in 10 years in December, if we don't have some dramatically lower prints on non-farm payrolls or a negative print on ISM services, Institute for Supply Management. So that's what I'm watching. If you get one of those two events, if you have negative print on service sector, the non-manufacturing part of the economy, or if you get a negative print on non-farm payrolls, then you will have the stock market tank, you'll have gold skyrocket, but you will not get an increase in the Fed funds rate.
Right, and this so-called recovery, I think we'd agree, if it is a recovery at all, it's very long in the tooth. You're talking about manufacturing data. ISM PMI doesn't look good. Right now, it doesn't look good, right? The August number wasn't good. We're
contracting in the manufacturing sector, and the service sector, I think, was the biggest drop in like four or 5 years. I don't recall. It was a huge drop. It was from 55 to 51.4. So it was a huge drop in the service sector.
Right. And so I guess the problem, though, is that the Fed, they say they're data dependent, but they kind of pick and choose what data they're going to look at. They don't tell us ahead of time. So
I can tell you what, let me stop you right there. The Fed is only comprised of labor market economists. So they believe that inflation is a product of a very low unemployment rate and a lack of slack, if don't mean to rhyme, but if there is very little slack in the labor market, that is what causes inflation. It's not the fact that they're at 0% Fed funds rate for 96 months. That has nothing to do with it. It doesn't come from the fact that they printed $3.7 trillion of base money, high-powered money. That has nothing to do with inflation. It's just when people become productive. That's what they believe. So the Fed is myopically focused on the non-farm payroll report. They don't care that current dollar nominal GDP is really at the lowest growth rate since 2010. It's been barely growing at all. Real GDP, as I said, was 1% year over year. Half the growth rate in core inflation. So they care not about that. They care only about the bogus numbers on U3 unemployment, not U6, not even U6. That's even secondary and maybe even tertiary in their mind. They're worried about the headline number and the U3 unemployment rate.
Yeah, PCE core showing, I think, 1.6 year over year. Understated, absolutely. Well,
CPI core to year over year is 2.3. So, yes, we do have the core inflation on the CPI is a little higher than the PCE.
So, what do you think the consequence will be of a December rate hike? Let's just give them the benefit of the doubt. By the way, the dot plots is a more and more comical value every quarter. And I can just throw this up here for the viewers. All the way. This is like the weatherman trying to forecast the weather out 60 months. They're trying to forecast what interest rates would be in 2019. One lone dot down below 1% to 2018 and beyond, kind of straying from the pack. I think this person was just asleep actually when they did the survey, just submitted the same answer. It's kind of ridiculous. But what do you think? Do you think, let's give them the doubt. Let's say they do go in December. What's the market going to, how's the market going to react to that?
Well, I don't know why it would be any different than what occurred in last December, in December 2015. I would think you have the same reaction to the market. Now, don't forget that, as I said, that will be 96 months of virtual 0% Fed funds rate. And if that changes in December, if they start hiking interest rates into a very, very anemic economy, what would be the reaction to the dollar? I believe the dollar would go higher. I believe commodity prices would collapse. I think oil prices would collapse. I think the estimate for earnings would come down because don't forget we have about 50% of the earnings on S&P 500 companies are from abroad. So you have a rising dollar. You have rising short-term interest rates. I think you actually would get a flattening of the yield curve. I think economic growth would stall. I think the reversal of the wealth effect. Don't forget, why has the Fed been engaged in 96 months of ZIRP? Why did they print $3.7 trillion? What is this method of operation on the part of global central bankers? They wanted to create a wealth effect. Well, that's what they've done. They've totally put a trenchant gap between basic fundamentals of economic growth and asset prices. So when they try to unwind this artificial stimulus, they're going to have a reversion to the mean. So I think the stock market comes in hard.
My guess, if I had to guess,
I'm sorry. One thing I want to add, and that is especially true if we don't see a huge increase in economic activity. So if we just have this muddling kind of 1.5% economy, which is actually much less than the trend from 2010 to the end of 2015. We're growing a little bit above 2%. Now we're growing about 1%. If you're going to raise interest rates into that environment, watch out below.
Yeah, I think the only way they get productivity or supposed productivity up is to start inflating yet another bubble. But my guess on the interest rate thing, Michael, is that we're going to have the most dovish hike that you could have in history. That is maybe a quarter point hike, but then language that puts the market at ease that this is not going to continue, and then you won't get the tremendous discounting of higher rates into the market in December and January.
Well, that would be your hope. I don't know if they can do that. See, the thing is that actually, how the old axiom, actions speak louder than words. You still have a dot plot, even though it's been lowered dramatically. You still have a dot plot that says that the Fed's going to be, 1.25%, 1.5% by the end of 2017. And really, they have no credibility. You have to remember, Albert, this central bank has lost all credibility. Nobody believes that they understand where they're going, because the Fed, if you put them under sodium pentothal, they would tell you they have no idea where interest rates are going to be going out a few quarters. No clue at all. In fact, they don't even know where they're going to be at the next meeting. They themselves have said they're data dependent, and I believe that they are. But what's evidently clear, abundantly clear, is they have no idea where the data is going. So what's going to happen is, in my opinion, if they do go ahead and raise interest rates in December, don't forget you're sitting on a massive bubble globally in the bond market and in global equities. So I think it's going to be shoot first, ask questions later. I think that if they do go ahead and raise interest rates, there can be no guarantee that they won't do it again at the next meeting. So people start worrying about 2017, especially if growth doesn't slow down. What happens if growth does not slow down and they raise interest rates? Well, then they're going to raise interest rates again and again, and they will do it again just like they did between 2004 to 2006, from 1% to 5.25%. They can slowly, although they'll do it much more slowly on a much more gradual basis, they're going to slowly hike interest rates until the economy collapses. I don't think they get very far, by the way. I've always predicted between 1 and 3 hikes before we manifest completely into a recession. And then there'll be the reversal, the grand reversal. That's what I'm really waiting for. When the Fed assents to the fact that they cannot have such a trenchant and divergent monetary policy between the BOE and the Bank of Japan and the ECB. That's what you have to watch out for. That's going to be the huge tradable event.
You mentioned the Fed sitting on a bubble. I think one day eckless is going to be an adjective to describe someone sitting on a crate of dynamite or something without even knowing it. The bond bubble is right under their nose or on their balance sheet. You're sort of an expert on this, having written that book several years ago. When you wrote the book, were you thinking primarily of sovereigns, or did you see that this would leak into corporates and high yield and everything else that has gone into it?
Okay, so in all candor, when I wrote the book, 2012, I knew it was a bond bubble, and I was the first, I don't say the first, one of the first to recognize that we were in a global bond bubble. But I never imagined that 25% of the entire stock of global sovereign debt would have a negative yield. I would never believe, even then, that a sovereign nation could get paid to issue debt. And what's worse is I never believed that the ECB under Mario Draghi would buy corporate bonds. This was never even thought of, that a central bank would buy corporate debt. And now they sent 30% of investment-grade debt over in Europe has a negative yield. So you've got trillions and trillions of dollars with negative yielding debt. That's why I say that a change in central bank monetary policy in anyone, in Japan, in Europe, in England, the United States, any change in central bank monetary policy, and a hike in interest rates is a change in monetary policy. That is going to scare the bond market, and it will scare the stock market just like it did in December of 2015.
So there have been some changes, Michael, but so far they're going the other way. So they're expanding QE. Japan is now targeting 10-year yields like we're accustomed to targeting money market rates. Are we going to start doing that?
Well, not straight up. See, the Fed is still. I just heard Esther George speak this morning, talking about how great the economy is. The economy's doing fine. She's worried about inflation, and she has that right. I would be worried about inflation too. I'm actually worried about stagflation more than just inflation. But she says that the U.S. central bank can hike rates twice in 2016. I mean, that means they're going to be going. You only have 3 months left, so I mean, she's going to be probably going in, according to her, if she had her druthers, November and December. So the Fed's, and by the way, there were 3 dissenters in last meeting, in the September meeting. This is a Fed that still believes, and they're clinging with unimaginable hubris to the belief that they solved all of our problems by printing $3.7 trillion and keeping interest rates near zero for 96 months. This is the mindset of the central bank. And it's going to take a recession before they get scared. And that's the watershed epiphany that I'm waiting for. Once that occurs, then you should really be short stocks, short the dollar, and really go long precious metals. Until then, it's going to be a little rocky. I don't want to, I manage money successfully for a living for a reason. I don't trade the market I wish I had. I trade the market that I have. And the Fed still has a hawkish, tightening monetary policy stance. I don't think the dollar, the stock market, or the economy can handle any hikes in interest rates unless they were to come out and say, we hiked once and we won't do it again until next year. But the Fed can't say that. All the Fed has to say, and this much I can promise you pretty much, even though I can't guarantee anything, is that Janet Yellen could say, well, the next hike, they're going to ask her, when's the next hike? We don't know. We don't know. We're not on a preset course. We're data dependent. Well, what if the data doesn't turn south? The market is going to react first and then sit back and watch. That's my base case scenario. That's my visceral gut reaction. And that's something you want to be short. You want to be short the stock market coming in December unless you see a dramatic weakening in the economic data, enough to get the Fed off of their high horse.
Okay, I'm going to go ahead and call the bluff on the 2 hikes this year. I think that's complete nonsense. Do you think that? Do you think we're going to skate through the election? Let's say they don't hike. Do you think we're going to get through the election?
My base case scenario. I'm sorry, I have to jump in. I do not believe Esther George is going to get her 2 hikes. I believe the best they will be able to do is 1 hike in December, and that is my base case scenario. They will hike once in December unless the economic data heads significantly south. Go ahead, I'm sorry.
All right, no, that's it. What do you think the Trump victory, for example, would do to the stock market in November?
Well, I mean, not to get into politics too much here, but I tell you this, that the stock market, I don't understand exactly why. I guess she's more of a known commodity, but I think the stock market prefers Hillary Clinton be elected. Traditionally, Democrats have been better for the stock market, traditionally. And then another thing, I don't understand why. No one, and especially Hillary Clinton, she's going to raise taxes on everybody. The economy is going to slow dramatically under either candidate's election, in my opinion. Mr. Trump has a much better monetary policy, perhaps, maybe better fiscal policy, in the fact that he'll lower marginal rates. But the short-term effects of his trade policy his mercantilistic trade policy will be very damaging to GDP growth. So I expect a tumultuous 2017 no matter who becomes elected.
All right, and we'll leave it at that, Michael. Thank you very much. I've been speaking with Michael Pento, the president and founder of Pento Portfolio Strategies, also the author of The Coming Bond Market Collapse. Michael, I hope we can do it again before too long. Thank you very much.
Thanks again for having me back on, Albert.
Take care. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.